Welcome everyone. Remember when we talked about compound interest and how it can supercharge your savings? Well, get ready for something even better. Today, we're diving into the world of dividends and how they can take your wealth-building game to a whole new level. We're talking about generating passive income and accelerating your returns, all without lifting a finger once you've set everything up, that is. Stay tuned as we unlock the secrets of combining dividends with the power of compound interest. Trust me, you won't want to miss this. Alright, let's break down dividends. Think of it like this. You become a part owner of a company by buying their stock. As a shareholder, you're entitled to a piece of their profits, which they give back to you in the form of dividends. Now, not all companies pay dividends. Some choose to reinvest all their profits back into the business for growth, but the ones that do, well, they're essentially sharing their success with you. Let's say you buy £1,000 worth of stock in a company with a 3% dividend yield. That means you can expect to receive around £30 in dividends each year just for holding on to that stock. It's like getting paid just for being a loyal investor. And the best part? You continue to own the stock so it can potentially increase in value over time. While most dividend stocks pay every 3 months or once a year, some stocks actually pay dividends every month. These are known as monthly dividend stocks and are popular among investors seeking consistent cash flow. They are often found in sectors like real estate, REITs, business development companies, BDCs, and certain exchange-traded funds, ETFs. Now you can choose to receive these dividends as cash payments, which is a great way to generate passive income. Or you can choose to reinvest those dividends back into buying more shares of the company's stock. And that, my friends, is where the real magic happens. Now, remember our friend compound interest? It's the concept of earning interest on your interest, creating a snowball effect that grows your wealth exponentially over time. Well, when you combine compound interest with dividends, you create a wealth-building machine that's almost unstoppable. Imagine this. You invest that same £1,000 in a company that not only pays a 3% dividend yield, but also sees its stock price appreciate by an average of 5% per year. You decide to reinvest those dividends back into buying more stock. In the first year you earn £30 in dividends and your stock grows to £1,050. But here's where it gets interesting. In the second year, you're not just earning interest on your initial £1,000, but also on the £50 growth and the reinvested £30 dividend. This means your money is working harder for you, year after year. Fast forward 10 years and the difference is staggering. Without reinvesting dividends, you might be looking at around £1,629. But with dividend reinvestment, that figure could balloon to over £2,100. That's the power of compounding in action. Now you might be thinking, if it's so great, why isn't everyone doing it? Well, the truth is, many people are. But it's a strategy particularly favored by the wealthy, and here's why. Firstly, dividends provide a consistent stream of passive income without requiring you to sell your assets. This is crucial for those who rely on their investments for living expenses or want to maintain a certain lifestyle. Secondly, in many countries, dividends come with tax advantages, especially when compared to other forms of income like wages. For example, in the UK, you can hold your dividend-paying stocks within a stocks and shares ISA, which allows your investments to grow tax-free. This means you get to keep more of your hard-earned money, which can significantly impact your long-term wealth. Of course, tax laws vary from country to country, so it's always a good idea to consult with a financial advisor to understand the specific rules in your region. But the key takeaway here is that dividends offer a powerful combination of consistent income and potential tax benefits, making them a favorite strategy for those looking to build and preserve wealth over the long haul. Now, before you go all in on any dividend stock, remember that not all dividend-paying companies are created equal. Just like with any investment, you need to do your research and choose wisely. So, what should you look for? First and foremost, look for companies with a solid track record of consistent dividend payments. Ideally, you want to see a history of increasing their dividends year after year, or at least maintaining them consistently. This demonstrates financial stability and a commitment to rewarding shareholders. Next, pay attention to the payout ratio. This is the percentage of a company's earnings that it pays out as dividends. A sustainable payout ratio is crucial. A ratio that's too high, say above 60%, might indicate that the company is stretching itself too thin and might not be able to sustain those dividend payments in the long run. And finally, look for companies with strong financials and a competitive edge in their industry. You want to invest in businesses that are built to last and have the potential to grow their earnings over time, which will ultimately lead to higher dividend payouts for you. Now let's talk about how to actually put your dividends to work. You can choose to receive your dividends as cash in your brokerage account, or you can opt for automatic dividend reinvestment, often referred to as a DRIP. DRIPs are fantastic because they automatically use your dividends to purchase more shares of the same stock, taking advantage of compound growth without you having to lift a finger. However, it's important to note that not all brokerage platforms offer automatic DRIPs. For instance, platforms like Trading 212 require you to manually reinvest those dividends unless you're using their Pi feature, which automates the process. So, make sure to check what options your brokerage provides. But even if your platform doesn't offer automatic DRIPs, don't worry, you can still manually reinvest those dividends back into buying more shares. It might require a little more effort on your part, but the benefits of compounding are well worth it. Now, before you jump headfirst into the world of dividend investing, it's crucial to remember that no investment is without risk. While dividend-paying companies can be a fantastic way to build wealth, it's essential to do your due diligence and research any company thoroughly before investing your hard-earned money. Don't just chase the highest dividend yields. Remember, a high yield can sometimes be a red flag, indicating a company might be struggling and their dividend payouts might not be sustainable. Instead, focus on companies with a solid track record of profitability, a strong competitive advantage in their industry, and a management team that prioritizes shareholder value. Take the time to analyze their financial statements, understand their business model, and assess their future prospects. Are they innovating? Are they adapting to changing market conditions? These are all critical factors to consider when evaluating a potential dividend investment. Alright, let's wrap things up with some practical tips to get you started on your dividend investing journey. First, if your brokerage platform doesn't offer automatic dividend reinvestment, set reminders for yourself to manually reinvest those dividends as soon as they hit your account. Consistency is key when it comes to compounding. Second, remember the importance of diversification. Don't put all your eggs in one basket, even if it's a seemingly lucrative dividend stock. Spread your investments across different companies, industries, and even geographies to minimize risk. And finally, if you're feeling overwhelmed by the prospect of researching individual stocks, consider exploring dividend-focused exchange-traded funds, or ETFs. ETFs are like baskets of stocks that track a particular index or sector, offering instant diversification and exposure to a variety of dividend-paying companies. They can be a great option for both beginner and experienced investors alike. So there you have it, the power of dividends combined with the magic of compound interest. Remember, building wealth takes time and discipline, but by incorporating dividend-paying stocks into your investment strategy, you're setting yourself up for long-term financial success. If you found this video helpful, make sure to subscribe and stay tuned for the next one, where we'll explore the best strategies to boost your income even faster. Until next time, keep learning, keep investing, and keep building that wealth.